Hi guys. Okay, so let's go over chapter 4, completing the accounting cycle. So this is just a continuation of chapters 1, 2, and 3, and it actually closes out everything in a full accounting cycle. So from the beginning of the year to the end of the year, up to closing all of the books and starting the new year. Okay. Resume slash oh, it's not being very nice right now. There it is. All right. So everybody should be looking at chapter 4's learning objectives, because I know that it's kind of hard to see on the screen because the light is so bright. But just follow with the PowerPoint slides. So again, this is chapter 4. All right, so prepare a worksheet and explain its usefulness. So you started working with worksheets in chapter 3, but you kind of finalize everything in chapter 4. It does help you to see all of the different transactions, including the adjusting transactions, to know what your ending balances are in each one of those accounts. It does help reduce the risk of errors. It links accounts and their adjustments, and it helps prepare interim financial statements, and it shows the impact of proposed transactions. So here are the 5 important steps in order to create a worksheet. So you want to enter the unadjusted trial balance. So this is all of the transactions that happen in chapters 1 and 2. So they're the regular transactions. They're more transactional, meaning that something happens and then we have to record that something in the financial or in the trial balance. Step 2 is you want to enter the adjustments. So the adjustments happened in chapter 3. That's when we do the depreciation, or we properly allocate prepaids or unearns and stuff like that. Step 4, sort adjust the trial balance amounts to financial statements. So they kind of have you break it down so that you can visually see what numbers goes to the, what different accounts go to the balance sheet, which ones go to the income statement, and which one goes to the statement of owner's equity. Step 5, total statement columns, compute income or loss, and balance columns. So step 5 is basically chapter 4, where you take all of the different entries and find out what the ending balance should be. So here's an example of a worksheet. You guys can go ahead and read through what the uses are on your own time. So you can just pause it now. Here's an example of a worksheet. So the following 10-column worksheet contains a year-end adjusted trial balance for Magic Company. As of December 31st, complete the worksheet by entering the necessary adjustments, computing the computing the adjusted account balances, extending the adjusted balances into the appropriate financial statement columns, and entering the net income for the period. All right, so we're going to do our first set of transactions. It's asking us, it's saying prepare and complete the worksheet, starting with the unadjusted trial balance and including adjustments on the following. The company has earned $9,000 in fees that were not yet recorded at year end. So at the end of each year, there may be transactions where we don't bill a person until after the year is over, or we built them too early, or a person pays us for something, or we do a service for a person, but for whatever reason we didn't get it in time in order to bill them, but we still need to record the revenue. This is an example of that. So the company has earned $9,000 in fees that were not yet recorded at year end. Let's just see. Okay. All right. So what's the best way for me to show this? All right, we're going to create our journal entries. So it says prepare and complete the worksheet starting with the unadjusted. Okay, the company has earned $9,000 in fees that were not yet recorded at year end. So if they earn $9,000 in fees that recorded, what are my accounts that I'm gonna utilize in order to show this transaction?
Accounts receivable. Cause they didn't, put it inside of the, what they owe to you, but you didn't receive it yet.
Cause it doesn't say that we received cash yet, right? So if we didn't receive cash yet, see, it says the company earned $9,000 in fees that were not recorded at year end. So we earned the money, we just have not been paid for it yet, right?
Mm-hmm.
And don't let the word fees confuse you, because this is the key word, earned.
Fees
We
earned.
earned the fees, so it's not an expense, this is a revenue. So we're gonna do fees earned, yep. Alright, so AR, I think we should always try to do our 6 over here. So we have D, E, A, we have clear, C, L, R. Right? So DEA plus minus, plus minus, plus minus, CLR minus plus, minus plus, minus plus. We have drawing, expense, asset, capital, and liability, and revenue. This is always debit, credit, debit, credit, debit, credit, debit, credit, debit, credit, debit, credit, regardless of what the type of account it is. Alright, so our AR is an asset account, right? So this is an asset account plus minus, that's plus, no. So this is a revenue account. So revenues are minus pluses, but it's still gonna be DC. Alright, so our AR balance went up or down? Up. So it went up by $9,000. Fees earned went up or down? Up. It is a credit of $9,000, so my debit equals my credit. So this is my transaction. So, the accounts that we're gonna impact are $9,000 credit for fees earned, and accounts receivable as a $9,000 debit. If you look here, you see how on the unadjusted trial balance, the debit balance is 188 and the credit balance is 188. This is why it's so important to make sure that your journal entries, your transactions are always in balance. All your debits must always equal all of your credits. So when you do each one of these transactions, you have to stay with that same concept, and you'll see. All right, so the next entry says the company incurred $2,000 in salary expense that was not yet recorded at year end. So the company incurred $2,000 worth of salary expense. So what are my two accounts impacted by this transaction?
Accounts payable.
Accounts payable, because we incurred the expenses, but we had not paid them out.
And what about what expense we want? Salary expense.
Yep, salary expense is the other. Alright, so as AP is what type of account? Liability, so it's minus plus. Salary expense is what type of account? Expense, so it is plus minus. Alright, so our AP balance goes up or down?
Up.
Up, because before we had $0 of accounts payable, and now we have $2,000 worth, so it has to go up. Salary expense go up or down?
Up.
It goes up because we need to show that we have salary expense. This is a debit, this is a credit, this is a debit, this is a credit. Our credits equal our debits. We're okay with that? So when we go to the adjustment tab, we're gonna adjust AP by $2,000. $2,000 as a credit. Right? And then we're gonna adjust salary expense by $2,000 as a debit. Everybody okay with that? Alright. Next one. Okay. The long-term note payable was issued on December 31st this year, thus no interest has yet accrued on this loan. Okay, so they're just letting us know that even though we have an account that normally is to be adjusted, in this particular transaction or this example, we're not gonna adjust it. Alright. So there's the $9,000.
Yep, it's there.
Cause you switched the,
Oh, the layout isn't right. I'm about
Yeah.
to say, give me a break. Okay, just pretend that my numbers are lined up with it. Well, they can't see it anyway. So, we did that though. We just didn't do the total at the bottom. So the $11,000. So you guys see that, right? Okay. Now we need to put the balances on there. I'm going to erase my numbers for the sake of we did it right. Pretend. All right. So then I need to do my balances. So what is my balance for cash?
13,000.
All right. What's my balance for accounts receivable?
Now 17,000, that's 8,000, 9,000 are added together.
I agree with you. What's my balance for land?
85 never changed.
What's my balance for accounts payable?
It's now 12,000.
On the debit or credit side?
It's on the credit side because it's higher.
And long-term payable?
33 on credit,
And Magic Capital?
75,000.
And Magic Withdrawals?
20.
And fees earned?
79,
And salaries expense?
56,
Just make sure you're paying attention to your credits and debits because they do matter. Office supplies expense?
8,000.
Alright, so I'm gonna cheat. I don't know my total. They're gonna add it up for us. So it's 199. 199,000 debit, 199,000 credit. Everybody okay with that?
Okay, so my brain wraps this up. Once you get the directions of what it is they want you to do in the first amortization, the adjusted trial balance wants you to add all the columns.
No. Yes, the adjusted.
Mhm.
Yeah, so this is the unadjusted.
Unadjusted.
This is the adjustments.
And then
This
you
is
add
adjusted.
everything and make sure that it goes in the correct column based on what, everything was in the adjusted trial balance goes in the trial balance because you added them together.
Yeah. What would be the other option?
Huh?
What would be the other option? If we didn't do that, what would we do with these numbers?
Just stay there.
Right, like, if we don't add them together and create a new trial balance, because these are in fact transactions, these are transactions, this is like 1 + 1 =
Yeah.
2, because if we don't do anything with this, then
They just stay there.
they just, like, there's no, you know what I'm saying?
Right.
Yep.
Okay. Now it's making sense. Now the homework's making sense to me now. Okay. Okay.
See, it's not, this part is not bad, but I do believe that that closing out the temporary accounts is probably something we should talk about.
Okay.
So those are our adjusted trial balances. So which accounts are gonna be on our balance sheet? Starting from the top, is cash on our balance sheet?
Yeah.
or is it on our,
It's on the balance
income
sheet.
statement?
It's on the balance sheet because income is not about, cash.
Alright, what about accounts receivable? Balance sheet?
Yep.
What about land? Balance sheet, income statement, statement of owner's equity.
Balance sheet. Payable.
Accounts payable,
Yep, balance sheet.
long-term notes payable.
Yep, balance sheet.
Magic capital,
Yes, on balance sheet.
so it's on the balance sheet and owner's equity.
And equity, yep,
Magic withdrawals,
on balance sheet.
balance sheet and owner's equity.
Mm-hmm.
And then fees earned,
These are,
Would it be income statement?
that's income statement.
that's the
Salary,
income statement, salaries expense,
income statement,
income statement, office supplies,
income statement.
income statement. Alright, so let's take our numbers to our balance sheet. So what should we put on cash? And I wanna know is it debit or credit?
It's a debit
Debit,
of 13,000.
13,000.
Accounts receivable is a debit of 17,000.
Yes, ma'am.
Land is a debit of 85,000.
Yes, ma'am.
Accounts payable is a credit of 12,000.
Yes, ma'am.
Long-term notes is a credit of 33,000.
Yes, ma'am.
And major capital is $75,000 credit.
Yeah, you do get that. Okay.
Alright. Then, the withdrawals,
Is
what does that say?
20,000.
20,000, that's a debit.
Okay. What about fees earned?
Fees earned is income statement of, is that 79,000?
As a credit. Alright.
And, was that salaries expense?
Mhm.
56,000.
56,000
Debit.
debit,
Mhm.
and then 8,000 for office supplies.
Mhm. Now, can somebody give me a calculator and tell me what our net income is?
For, what's the numbers?
79. 79 minus 56 minus 8.
15,000.
Right. Does everybody know how to tell what to add and what to subtract? Okay, so it's the same concept as trying to find the balance of the T table. So
You add
these are
those
your
together.
credits, these are your debits.
And those
You
together.
add these together,
subtract.
add these, add all of these together. So do the difference between the two, and the balance goes on the highest side.
15,000.
Okay. So you said it's $15,000.
Credit.
Because if you notice in accounting, you see no negative numbers on the financial statements and stuff like that.
It makes it
So
the
it's,
homework.
it's for the most part, you'll see negative numbers on a trial balance, you can, but that's only like something is wrong if you see a negative number on the trial balance,
So
because
what if it's in parentheses?
it's it can be, that's a negative number.
Right.
But when you look at them, there's no negative when you look at the actual financial statements, unless something is wrong. Because the numbers, the credits and the debits, those sides determine whether or not it's a increase or a decrease. You know what I'm saying? Like, although the number of expenses is a positive number, we know that in order to come up with net income, we have to subtract it from the revenue. There's no negative in front of it, but we know that in order to come up with net income, it has to be subtracted. In order to analyze it, you may have to add and subtract numbers, but the numbers themselves just represent how much is in that bucket.
Okay.
So you don't have a negative number inside of a bucket. Like, you can't have negative cash in a bucket, right? So if you see a negative cash balance on the financial statement, something is wrong, because it should have just been a credit or something like that.
So
Yeah.
it's actually in the wrong place then.
Yeah, something is wrong. There needs to be another entry to correct it. Because you can't have negative number. I mean, you can if, like, your real life bank account balance is negative and you owe them. So, all right. So we got all of our numbers for the balance sheet.
Split them out, so
Okay, hold on. So they put their 15,000 on this side. So if they put it here, That means it's not recognized in debit or credit. They're not recognizing it on the worksheet. They did the adding and subtracting for us. So they put the 135 here. That's all the debits. 120 here. The difference between these two is the 15,000. They have it listed as a debit on this side, which this is a debit, and this is off by the credit amount, by a credit amount of 15,000. So the balance of those two keeps the full thing in balance. So it's 135 for debits, 135 for credits. So this entry here is actually an entry that is created. We'll talk about this. This is a closing entry, and that's going to keep everything in balance. And that way, your accounts start over at 0 at the beginning of the new year.
This is what you do every day?
It says use the information from the completed worksheet in part 1 to prepare adjusting entries. So there's our journal entries. We created them using our T-tables earlier today. Accounts receivable is our debit, fees earned is our credit, salaries expenses are debit, accounts payable is our credit, and no journal entry required for, I think that last one was for the payable, the interest.
We have none.
We don't have any, so,
Instructions.
yep. All right, so now you're gonna prepare the income statement. Thank you. All right, thank you, babe. So you want to prepare the income statement and the statement of owner's equity for year ended December 31st and the unclassified balance sheet at December 31st. So in order to create the balance sheet, you're just going to take all of the dollars for the balance sheet accounts. So you got your $13,000 from cash. I mean, we saw all of this stuff.
So those are
Right.
the numbers that we called out.
Yeah.
Cash, the receivables, land, payables,
Mhm.
the different buckets. So that's what's on the balance sheet. And then the difference between the balance sheet and the owner's equity and income statements.
Mm-hmm.
Okay.
So revenue would be like fees earned.
Yes. So this is the actual, so the very first one is the actual trial balance. The one at the bottom is the actual balance sheet. So you'll look and you see it's the same thing that's listed on the worksheet before. Hopefully this makes sense just by looking at it. So you got your balance sheet, there's your balance sheet. Then you got your income statement and you got your statement of owner's equity, right? The key thing here is just to see how everything kind of is in balance. And this is the statement of owner's equity that they have listed on here, and the income statement that they have listed is prior to the end of the year's transactions. So when they have the $75,000 here, this is as of 2016. So this needs to be adjusted. So this needs to be adjusted for the end of the year based on all these transactions. So we need to add in what happened at the end of that last worksheet that we did. So we had our net income of 15,000. So it was 79,000 minus 64,000. So there's our 15. Well, if we have net income of 15,000, one other thing that was listed that was not on here was this $20,000 for withdrawals. So they added the $20,000 on withdrawals. So 75 minus 20 is, what's that, 55?
Yes.
But this is not complete because you also need to take into consideration the net income. So let's go to the next slide. All right, so there we have it. They did go ahead and they put the net income in there as well. Net income is an increase, so this is a logical thing, right? So the capital, so 75,000 is what he invested at the beginning of the year, okay? He said, I'm gonna start this business, I have 75,000 cash, I'm gonna utilize the 75,000 in order to get this magic company up and running. In the midst of that year, he said, oh, I need $20,000 of that money back because I need to pay my personal bills. So he withdrew $20,000. So logically, if he put in 75, but he took back out 20, really he only put in 55 now, right? So at that point, before we added this net income, he had 55,000 worth of capital in the business because he took $20,000 out. All right. So then, what's the other way to impact your ownership in this company? Now that the year is done, you have to make a decision on what you want to do with the money that you made. So the way to calculate and understand how much money, how much equity you have in your business is now to add that net income back into your capital. Because it's your money, you can take it out, but instead of taking it out, you're saying, I want to reinvest it into the business. So I'm not going to keep this 15,000. Let's take it back and put it into capital. Because I have the option to take it out. If I want to take it out and I want to keep it for myself, I can. It's outside of the financial statements, I'm good to go. If I want to turn around the next day and said, oh, okay, never mind, I thought I was going to need it, but I really don't need it, so I'm going to reinvest it back into the business. That is his money, the owner's money, and he can do with it what he chooses, and he is choosing to reinvest that money back into the business. That's why it ends up going back into a new capital account. That's the thought process.
At the end of the year, it goes back into account.
At the end of the year, it goes back into his investment.
Okay.
Because this is in fact his investment. He did all of this work. He was able to make $15,000. He's gonna invest it back into the business, so the new capital amount is gonna be 70,000. Okay? Does that make sense? So basically, he was able to make and keep $5,000 of what he already invested into the business. The rest of it, he's gonna leave it in there for future state. All right. So now we can produce our equity section on our balance sheet. So, and this is the new one, right? So this was 2016. This is 2017. So in order to keep everything in balance, our total assets was 115,000. Remember, we were missing. If you look at the balance of it, that net income that we had is now inside of this. So all the withdrawals are in here. All of the investments are in this $70,000. So now my A equals L plus OE is in balance now. So my 115 equals 45 plus 70 equals 115. Makes sense? It just looks like a bunch of numbers, but it's all numbers you've seen before. Okay, so all of that, and the biggest thing about closing a month is that you want to be able to open up a new month, right? So we have these accounts that we've created. We created these asset accounts, and we've created these liability accounts, and we created like these revenues to show how much money we've made, and we created these expenses accounts to show how much money we've spent in order to make that money. So with each one of these accounts, if you think about the account logically, it makes sense what's temporary and what's permanent, okay? So if I'm looking at cash or supplies, and I want you to think about this, or land, all of these are asset accounts, right? So at the end of the year, if my balance in cash on December 31st was $7,892, what's my balance in cash on January 1st?
Same thing.
$7,892. I don't know why I picked that number, because let's just say 8,000. That was a lot of digits.
You gotta put it
And
in
I
a
much do you have in supplies? $2,000, okay? So asset accounts are permanent accounts. Meaning that on December 31st or January the 1st, that cash balance is not gonna change unless there's a transaction that changes it, right? Liabilities. So accounts payable, notes payable, mortgage payable. If I owe somebody on December 31st, will I still owe that person on January the 1st?
Yes.
Unfortunately, yes. That does not go away. Liability is a permanent account. So, when it comes to the different financial statements, what does asset and liability have in common? Which financial statement do those sit on? Balance sheets.
Oh, okay.
Right. So, ta-da, the balance sheets keep hold of the balances, right? So the balance sheet ones, those are permanent. We do not have to do any adjustments to those. All right? They keep the balance indefinitely. If you go and you have a company that's been around for 20-something years, the cash balance has been a running balance. So that balance has been kept and recorded for the last 20 years, okay? You don't need to go and add or subtract or multiply. Whatever that balance is, it's been running for year after year after year, which is why it's so important when you, if you were to get into accounting, to have the cash reconciliation. Like a person can do cash reconciliation and literally do their entire accounting for their business. So this is beside the point, but I'm gonna tell you guys anyway. That's why
AP, what?
AP, MP, notes payable, and mortgage payable.
Oh,
Payable. So that's why accounting software has become so good for small companies, especially like if you're just starting out and you are handling everything yourself. So what QuickBooks has done is QuickBooks says if you download your banking account and you utilize that for everything, and most small businesses are cash, so you don't have to worry about any kind of adjusting entries, right? If you pay for your insurance for the year in November, you're gonna record it in November because that's when you paid for it. So there's no adjusting entries for the cash, for cash counting companies, which are most small companies. They basically say, if you download your bank account to our QuickBooks system, we can guarantee that your account is gonna be pretty accurate, you know? So the only thing you need to add to your QuickBooks is gonna be journal entries, like situations where you pay cash instead of using a credit card. So all of my clients that I utilize, I have all of them on QuickBooks, and I threaten them to make sure that they don't use any cash, because then they have to remember to include that transaction in their accounts. But if you use your credit card, it will take care of every single piece of revenue that you made and every single expense that you made, and it will always go into your accounting record, and you can produce your financial statements as long as your categories are right.
Is it, might be a dumb question, but isn't it possible for someone who does like accounting to kind of like get things mixed up like very easily and then like messes up the whole?
I mean, I would assume that somebody who does accounting isn't gonna mess it up.
I didn't know if like you get so like if you're doing so many things and you're just like if you accidentally mess it up.
No, we have to have, like, as an accountant, we have to have an end result, like, credits must, it's so many different things in accounting that make sure that you're kinda doing it right. I mean, you can mess it up, but you can fix it. If you're a
Okay.
good accountant, you should be able to fix it. It can't just be messed up. It's just not.
I didn't know if you get like too like caught up and you're just like, okay, this and this and this and then.
It's not really possible. So we have our permanent accounts as assets and liabilities. Okay, so what about expenses? If I have $2,000 a salary expense for December, does that mean that I also have $2,000 worth of salary expense for January?
Depends if they work.
Right, it's gonna depend on what actually happens in January. So, these are temporary, so what were we doing, expenses? So these are temporary accounts, meaning that these are a point in time, so whatever I'm doing in December may or may not necessarily be the same as what I'm doing in January. So if I wanna show a good representation of what we did in December, or what we did for the previous year, I can cut that account off in order to show the new month as starting from zero. Does that make sense? So, if I have salary expense, or if I have supplies expense, these are temporary accounts, and I need to start that account from zero each year so that I can only show the transaction that happened during that year. We don't typically close out these accounts on a monthly basis, but you do still have those same transactions. So when you run like if you run a report to show yourself how much you have in salary expense, you can stop it at each given time to see how much that is. You can look and see how much you spend in a week. You can look and see how much you spend in a month. You can look and see how much you spend in a 2-month or a quarter. Whereas cash, you can only see what your cash balance is up to that day, right? With expenses and with revenues, you can see how much the revenue and expenses are at any given time period. Does that make sense? Cash is gonna be ongoing. The previous day is gonna impact the next day, but expenses and revenues, that's not the case. You can start at zero each new day to see this is how much I made on Tuesday. This is how much I made on week 2 of the month. This is how much I made in the month or in the quarter or in the year. Does that make sense? So revenues are temporary and expenses are temporary accounts, and those go on the income statement. So basically, the balance sheet is a permanent account. You don't have to make any end of the year adjustments to close out the accounts, but income statement accounts are temporary accounts, so you do have to close them out. All right, so what you're doing in this closing process is you're resetting your revenue and expenses and your withdrawal account balances to zero at the end of the period. So withdrawals is going to be reset as well, because you do want to show that this is how much you took out for this year, not for, like, that's not an ongoing balance. That's just for a specific point in time. So number 2, help summarize a period's revenues and expenses in the income summary account. So here go my temporary accounts and my permanent accounts. So revenues, expenses, and withdrawals are my my temporary accounts. Asset, liabilities, and owner's equity are my asset accounts. When we do the closing process, the only accounts we're going to impact are our temporary accounts. Make sense? All right, describe and prepare closing entries. This needs to be memorized. You need to know how to do this. You're going to close the credit balances and revenue accounts to income summary. So income summary is, every company, it looks different for them, but income summary is it's an account that we created, and it is used to take all of the revenues and expenses and put them in one account. Does that make sense? So we're going to make all of the expense account balances zero at the end of the year. We're going to make all of the revenue account balances zero at the end of the year, and we're going to put them all into income summary. The balance for income summary is going to be our net income. Does that make sense? So net income is going to sit in one account. Okay, so close credit balances and revenue accounts to income summary. Close debit balances and expense accounts to income summary. Close income summary accounts to owner's capital, and close withdrawals to owner's capital. These are the 4 steps needed to record the closing entries. That needs to be memorized so that you know your 4 steps. 1 and 2 is going to be easy. Close out your revenue expense accounts. You just got to remember to then close out the income summary account to owner's capital, right? Because remember that $15,000, we wanted to add that back to the capital account. So this is the journal entry that's needed in order to do so. Okay? And all of these are journal entries, just so you guys know. All right. So here are the closing entries, and they give you the 1, the 2, the 3, and the 4. All right. So first they want us to close out the revenue. So we can look and see that consulting revenue had a balance of $78.50. Give me 1 second. I want to make sure they give you guys the journal entries. Okay, these do require journal entries. I'm not sure why they're not making the journal entries in here. But the way to close this out, you got to create journal entries to close this out. So I'm going to create the journal entry up here. I don't know why they didn't, but we're going to do it. So this is not like this fictitious in our head on a separate sheet of paper type thing. These are real transactions. So I would just abbreviated depreciation expense. So this is plus minus because because it's an asset. No, because it's an expense account. All right. So the balance was $300 before. I'm trying to figure out the best way to explain it. Salary expense. So this is $16.10. Insurance expense. This is $100. And then we have rent expense. And that is $1,000. And then we have supplies expense. This is salary. And this is 1050. And then we have utilities of 305. Alright. And then we have our revenue accounts. Alright. So use the current entity table. Alright, so revenue is consulting revenue. And rental revenue. 300. Okay, so our journal entry is to make this balance 0. And the other side of our entry is income summary. This is a T table as well. So income summary. I never remember whether or not this is a plus or minus. Alright, so if we're gonna do a credit to close this out, and now the balance is 0, the other side is gonna be a debit. I need to do my revenues first. So we already did the depreciation. Let's go back and do consulting and rental revenue. So if I want to close this out, I'm going to do a credit of $78.50 to close it out to 0, right? So if this is going to be a credit, then I need to do a debit on this side. Same thing for rent, for whatever kind of revenue this is, rental revenue, right? So if I want to balance it out to 0, then I need to do, I did a debit, now I need to do a credit. So this is A, this is B, now one is A. So this one that we did before is actually C, because now we're working on closing out the expenses. And then the salary expense is $16.10, So we did our revenues. We did our expenses. So this income summary balance should be 3785. Can somebody add that up, make sure I did it right? You're comparing these two?
Which one?
These two. So somebody can do the debit side, and somebody do the credit side.
I got the right side, it's 8150.
Alright. I'm gonna put this temporary 8150 here.
And 3785 is correct one.
What's this side? What was this side?
4365.
Oh, no, I really wanna add this up so I can make sure I did it right.
300.
300 plus 1610 plus 100 plus 1000 plus 1050 plus 305.
4365.
4365.
I didn't wanna go off of the thing in case I did something wrong, I wanted to add them myself. So, 8150 minus 4365,
3785.
okay. So this side is bigger than this side, so the balance goes here, 30 what?
3785.
Okay. So I just wrote these there temporarily so I knew what the numbers were. But this side was bigger than this side, so this is gonna be the side that it sits on. So basically this means that we made $3,785. Okay, so this is our net income. Now we need to close out, okay, so we closed out our expenses to income summary. We closed out our revenues to income summary. All of these balances are now zero. We move them all over here to show how much money we made, because the difference between revenues and expenses is net income. So the difference between revenues and expenses is our net income. So this is our net income. So we're gonna take our net income, and where do we talk about moving net income to before?
To capital.
Our capital account. So we're gonna move it to our capital account. So let's do capital. Minus plus. The balance before was 30,000. So we're gonna add, so we're gonna add more capital. So we're gonna add this 3785. Okay, so if this is, wait. I'm gonna end up closing out income summary. They don't tell you that, so this was the balance.
Well, that's $200 draw.
Yeah, but I wanna create the journal entry. So this journal entry is actually a credit to capital and a debit to income summary. So what's my balance now in income summary?
0.
Our balance in income summary is 0. So this is just a temporary account that we use in order to close everything, right? So then it comes over to here, so now our balance in this is 33,785. But we also need to close out our drawing account, right? Cause remember, what were the 3 temporary accounts? Revenues, expenses, and drawing. So revenues is closed out, expenses is closed out. Now we gotta close out drawing. So drawing had a balance of $200, but I want the balance to be 0. So I'm gonna do a credit to it. Now balance is 0, and then here's my debit. So 200. So now if I do my actual final balance at the end of the year, what was this? So it's 33,585. Yep. And that's the number we're looking for. Does that make sense? So that's the closeout entry. So 4 steps. Close out revenue, close out expenses, close out, so move net income, and then close out drawing. Right? So you gotta close out the income summary account. Everybody okay with that? So that's the journal entries for that slide. It looks like a lot, doesn't it?
Checking, scratching, circling, crossing.
Yeah, you gotta follow. You can't just look at it. You definitely have to follow that. Alright.
Do you want me to erase
I
the
am
next
going to let you guys go on break.